Hello and welcome to our viewers on cruxinvestor.com and also to our listeners on Cruxcast, our podcast series. And for those of you new to Crux Investor, click the button in the corner of the screen to subscribe to our YouTube channel. We're talking today to Geoff Hampson. He's the CEO of Para Resources. They're a Canadian junior explorer with assets in Arizona and Colombia. We're talking with Geoff about the company, their strategy, and their access to cash. These and other topics are in the description below. Click on the timestamp and you'll go straight to the relevant part of the video. So, hello, Geoff. How are you?
I'm doing very well, thanks.
Well, thanks for taking the time to speak with us. We usually get people to kick off with a sort of 2-minute summary on the business, and then we'll kind of get into some questions after that.
Okay. So Para Resources is a junior mining company. We have a couple of different properties, one in Colombia and one in Arizona in the USA. Both are gold mining opportunities. And when we started this company, we really started looking for mining properties where there was an existing infrastructure, an existing mill, but also where there was a lot of exploration potential. So we wanted to sort of bypass the period of time that it takes from a greenfield exploration to production by having some small production that could generate cash flow, where the permits were already in place and where there were some sort of underexplored opportunities.
Right. Well, okay, thanks. That's quite concise. So if we don't mind, can I just explore that a little bit further? Because I think it's fascinating. Different companies with different strategies, hoping for the same outcome, obviously, but that doesn't always turn out that way. So tell us a little bit about you. I know you're a finance guy by background, but you've got a big team of technical people. So you've gone out and identified 2 assets which meet the criteria that you specified, which is great. Was there any competition for them, or did you get lucky, or who did you know?
Well, I think that, just about my background, I've been an entrepreneur for 35 years. I've built a number of different businesses. I've been successful in, being sort of contrarian and finding my entry point at sort of the low point in the market where the sector was out of favor. I'm a believer that, you make money if you buy well. And you have the right people and the sort of right macro, environment opportunity. So one of the reasons that we've been able to acquire these properties and acquire them relatively cheaply and if you look at it in a historical perspective, is because the sector has been out of favor and there has been no money. And so junior mining companies have really struggled over the last 5 years because the cycle changed, particularly with gold. Some of the majors overspent, leveraged their balance sheet, made bad acquisitions, and have spent the last 5 years really just kind of trying to fix their balance sheet by selling off non-core assets, by producing, but by not exploring and not increasing their reserves. And that has traditionally been kind of one of the sources of capital for the junior mining industry, because the majors have allowed the juniors to take the risk and do the exploration, and they've funded some of the juniors as they've started to develop resources. That has completely dried up, and the retail investors have fled. On the Toronto Stock Exchange, the Venture Exchange, everybody has been making so much money on marijuana stocks that nobody's really interested in the resource sector. So while that's a problem, it's also has created an opportunity, and because of that, asset values, equity values are at historic lows. So we've been able to take advantage of that by buying cheaply.
Right. So no one sells their good stuff, and certainly not cheaply. So what did you like about these assets specifically? You said one in Arizona, one in Colombia. So they're not too far apart, but you know?
Well, worlds apart. But what we liked about them was that, and maybe I can just talk about them individually, because
Okay.
in Colombia, after the government made a deal with FARC, vast portions of the country that had been sort of off, sort of off the grid in terms of being welcoming for Western mining companies, opened up. And there have been a lot of small artisanal, some legal, some illegal miners. And we looked at that as being an indicator of where there might be gold. And we identified the El Limon mine, which was a relatively small mine, 75 tons per day, 25 years, but still producing. But when we looked at that mine and the fact that it was fully permitted, that it has capacity for tailings, there's lots of water, and the fact that all around that area there were all these small miners, but that the area had never been drilled. So we said, okay, this fits our criteria. A small existing mine, fully permitted, that with a little bit of work can be rehabilitated and improved to produce cash flow to fund an exploration program in this valley. And so we acquired the mineral rights for a sort of a 12-kilometer long stretch where there is this a vein system that we know is there because of the small miners, and that we know that it's the same vein system because we were able to go and check the geology. So the idea is that we took this mine, increased the capacity from 75 tons per day to 225 tons per day, and then went out with the government to try and formalize some of these other small mines. And so the government told us that that would take about 6 months, but in fact, it's taken about 3 years. And so we're just now starting to see the ore coming from these other parts of the vein. We're operating, we're cash flow break even, but we have a plan over the next year to bring these additional sources on, which will get us up to full capacity. So the idea is, fully permitted, ready to start producing, and exploration potential. And we've looked at hundreds of different opportunities, and have found 2 that we've acquired, and we've got a few other ones sort of in the pipeline that we're looking at.
Right. So how much have you spent on that to date, and what do you think it's worth today?
So the acquisition costs, the rehabilitation of the mill, the permitting work, about $12 million US in Colombia.
Right. And how much more to go?
It really doesn't need that much more. If it needs more, it would be in the hundreds of thousands of dollars, but it's fully funded and it's cash flow break even from operations today. Most of the CapEx has been invested. So we're sort of ready to go as we ramp up the production from these other mines.
Right. And I'm sorry, again, help me. What are you hoping for in terms of production amount there?
It's in 2020, we should be somewhere around 8,000 or 9,000 ounces, but in 2021, that'll go up to around 15 to 20,000 ounces.
Right.
It's very grade dependent.
Right. Yeah, absolutely. And it's a reasonable grade as well, from what I can read. So the hope is what there? That will be a cash generative business to do what? Develop further, explore further, or is it create cash for other parts of your business? What's the thinking behind El Limon?
So the mine site is fully permitted to 400 tons per day. So we have expansion opportunities there. But in 2020, when we're producing, we will start an exploration program on this vein. It's called the O2 vein. It's about 12 kilometers long. It's a series of parallel veins. Sort of average grade on a fully diluted basis is around 7 grams per ton. Some parts of it are higher grade. But as we start to drill that out, we would expect that we would be able to build a sizable resource. So we have a target of about 1 million ounces to be discovered in the next couple of years, at which point we think that we can justify increasing the capacity of the mill to 400 tons or more per day. And at that point, sort of generating $20 to $25 million a year worth of cash flow. So
Okay.
we also think, and this is sort of more of a macro discussion, we also think that as the cycle for the gold mining industry changes, and I can talk about what I think are those indicators, that the majors who have not been replacing their reserves that they've been mining over the last 5 years will be looking to buy reserves because it's cheaper to buy to buy gold in the ground than it is to actually go out and explore and find it.
But it's going to take a lot more ounces than 1,000,000 ounces for them to kind of come knocking at the door, isn't it? So that's why I ask, what's the hope? What's the blue sky for El Limon?
Well, I think there is potential for more than 1,000,000 ounces. The cost of producing gold there is relatively low. It's about $725 an ounce, and with a capital cost of $12 million, our payback is sort of a year and a half. And as we increase the size of the reserves and we increase the size of the mill, that's gonna grow. So it's going to be a very nice cash flow business. But I think that there's several different tiers in the gold mining business. There's the juniors, there's the mid tier, and then there's the majors. You're absolutely right. The majors aren't going to come knocking for 1,000,000 ounces, but the mid tiers will.
But this is why I ask you about strategy and why I'm always interested to understand the conversations that the board or the management team have. It's a nice cash generating business. If you think it's got potential to, be a 5 million, 7 million ounce resource, then, that's fantastic. You'll get a lot of people knocking at the door. But if it's producing a lot of cash, there's maybe, and I know you're going to talk about Gold Road in a minute, it helps with another target. I mean, say, where are you positioning it? Is you think it's a nice, small, standalone business which may be able to grow, or do you think it's part of a bigger story that you're trying to tell?
We particularly like South America and Latin America. Our team has a lot of experience there, and we see this as a sort of a platform. We will use the cash flow to look at other acquisitions. We've got other things that we're looking at in Colombia, but also in Ecuador, and in Peru. So we see this as a sort of first step to building, a mid-tier producer in the region.
Okay, so are those conversations ongoing at the moment, or are they?
Yes,
once you've got some
yes,
cash?
they are.
They are. Okay, and obviously there's a few people trying to do the same thing, so it's a competitive environment. You've got quite a few locals working for you, I believe, in the sense of the general manager. Element is South American, etc. Right?
Yes, that's right. Yeah, and we've got a number of people. Randy Martin, who is on the board of directors and the COO, has been very successful in Latin and South America and building out gold mines. He's built some, sold some, and has very deep contacts with government and agencies, and we see a regular stream of opportunities. But we're pretty picky, and so they have to meet the criteria that we've established, and we have to be able to buy them well. And you're right, there is a bit of competition, but typically the opportunities that we're finding are not being widely marketed. And so it's really more based on relationships and being able to go in and talk to the owners and work out a deal. So very few of these companies that we're looking at have actually hired an investment banker or have any kind of a process to try and sell the asset. So it's really sort of showing up and saying we want to buy it and working out the terms.
But how do you do that? Because again, I do hear that story a lot, and what I'm trying to get at is the point of differentiation for you guys. So I know you've got a finance background, it's a very successful man. Have you got ready access to cash? I know one of the shareholders of your business. Have you got ready access to cash to be able to have those conversations, to turn things around quickly? Because that's what it sometimes takes.
Yeah, and the answer to that is yes. And I think that we've demonstrated that by the fact that the insiders, myself and particularly Glenn and Randy, we have put up the majority of the money that has gone into this company. We're now, between the three of us, about $30 million deep into the company. And we have additional resources that we will we can deploy quickly if the opportunity comes along. But there's also an advantage of having, an operating profitable mine. And for instance, our operation in Colombia is unlevered. So, next year, as we're starting to produce cash flow, we can use that as a base to be able to go out and make other acquisitions.
Right. Well, that's what I'm coming to. This is what I'm trying to understand. How do you build this? Because otherwise, there's a danger of it being the same story as lots of 35 million buck companies in the same position. It's what do you have that others don't? You've got your own cash in it, access to, well, you're saying further cash from yourselves, but the ability to go to market, you think, with the right story.
Yeah, I mean, I think that is the differentiator. Plus, I think the experience of the team and knowing, how to make these operations work. I mean, narrow vein underground mines are a bit tricky, and so you need to have expertise and people who know how to make them work. And lots of examples of projects where they have a PEA or even a feasibility study that says that they can make money, but then when they actually get into the ground, they can't figure it out. And often we've looked at a number of those types of opportunities that are essentially distressed plays, and some we've passed on, others we've looked at and said, well, we would do it differently, and here's what we would do. And so there is an opportunity there when you've got access to capital and you've got the expertise and the track record of working in that environment and also working in that kind of mine.
Yeah, well, Alex, I think the ASIC number is impressive. If you can deliver that, that's great. Obviously, the grades help. And why don't we get on to Gold Road, and then maybe might be able to join the conversation up then.
So Gold Road is a bit of bigger operation. It's a 500 ton per day CIL plant, fully functioning. We acquired it end of 2017. We did a PEA and which showed that it had an $85 million NPV, that we could produce 35 to 40,000 ounces a year at an average cost of an all-in cost of about $825 per ounce. So we bought the asset for $6.1 million. So we bought it well. We had an appraisal done on the equipment, and it came in at over $20 million. So just on the orderly liquidation basis, we could have doubled our money if we had chosen to do that. But so it fit one criteria, which was buy well. There's a resource in the mine of 215,000 ounces. So that gives us a 7-year mine life, but it's open at depth and open on strike. It's got an average grade of around 7 grams per ton. So it's a nice mine. It's in a great jurisdiction. The Oatman district is a historic gold mining area. The mine itself is right on Route 66. And so it's easy access, 2.5 hour drive to Las Vegas. So it makes it easy to get to. And it's a mining district, so lots of people and suppliers and so forth. Very, very different than doing business in Colombia, where getting people and expertise and suppliers is a real challenge. So what we've done is we've rehabilitated the mill. We've done a lot of work and development work underground, and we're essentially a couple of months away from mining. Right now, we're just opening up a new area and at the 900 level. As soon as we've completed the drift to the end of the ore chute, we'll put the secondary escape route in, and then we can come in and start mining. That's probably going to be sometime around October or November, and we'll be able to go right to full production now. We're actually stockpiling some material now as we're doing the development work, as some of that development work is in the vein. The vein at Gold Road is so typically around 3 to 8 feet in width, so it's much wider than what we have in Colombia. The grade is about the same as Colombia, but it's easier mining. And when we did our technical report, our consultants indicated that based on some of the drilling that had been done at depth, that wasn't enough to put the ore into the resource, but indicated that the vein was open at depth, and indicated that they thought we could increase the resource by sort of 700,000 to 1 million ounces. And so over the next couple of years, we will do that. We've already started drilling, but this mine is in very, very good shape. We've fixed some of the problems that were in the underground that were causing the previous owner to have some problems. Just some fairly simple changes to the mining method, and just things like straightening out the decline and so forth. So, I mean, we've done quite a lot of work there, and it's really looking good right now.
So, I mean, just okay, tell me about the mill bit further, because I just want to understand that, and then, like I say, I want to bring this conversation back together. The mill you've upgraded, it's got potential to be upgraded further, presumably.
It's when we acquired it, it was 500 ton per day.
Okay,
CI.
yeah. And
and so what we've done is we've gone in and just completely, sort of done maintenance, I guess you could really call it, because it was fine before, but we've replaced hoses, put in new bushings, changed fluids, basically tested it. We've tested the whole circuit now. We've actually produced gold, so we know it all works. The recovery is very good, 95% recovery. So the mill is in great shape. The underground is almost completed in terms of development work, and we're ready to start producing.
I guess what I was alluding to was, how does it go from 500 to 1,000 tons per day, for instance, and how much that cost you, and when do you make that decision?
Right, it's fully permitted for 1,000 tons per day, so probably about $20 to $25 million worth of capex required to double the capacity of the mill. Depending on how we build out the resource, we'll make that decision.
Yeah. Okay.
What's interesting there about the exploration potential is that we've also acquired an adjacent property. There's actually a series of 3 veins that run through this area. Gold Road is the northernmost vein, but about 1.5 miles away is what's called the True Vein, and the True Vein has 7 historic mines that were built and mined from 1890s through the 1940s, and 1.3 million ounces have been produced out of the True Vein. But what's interesting there is that the vein widths are quite a bit wider, 13 to 15 feet in width, and the grade is much higher. So the average grade over the history of the mining on that vein has been 23 grams per ton. So, and because the way that the mining was done back in the old days is that there was an outcrop that showed the vein, they started mining and they chased the vein. But it's a continuous vein, and it goes for about 2.5 to 3 miles, but it has never really been properly drilled. And so there's a series of mines along this vein, but it's never been drilled between the mines. And the cutoff in those days was 0.5 ounces per ton. So if they got to a section that was at 5.5 ounces or lower, they would just stop. So we know from the historic mining records that there's an enormous amount of ore that's still in there. And it's higher grade than at Gold Road. So and because it's only 1.5 miles away on a paved highway from our mill, we're hoping that we'll be able to establish some tonnage there, and that we'll be able to mine that higher grade material as well. So long story to come back to the mill expansion. If we establish tonnage at a higher grade, then we'll obviously want to mine that, and we'll need more capacity. And sort of keep the numbers straight. I mean, 7 grams per ton at Gold Road yields 35,000 ounces per year at the mill, at 500 tons per day. But if we're able to find ore that matches the historic grade, and we'll keep the math easy and say 21 grams per ton, because it's 3 times, then we're talking about 125,000 ounces per year, and the average cost, all-in cost, goes down to about $500. So that's the exploration potential. We don't know for sure what's there, but certainly the fact that there has been historic mining there is a good indicator that there's gold and that it's
Yeah.
open at depth.
Yeah, bit of work to do between now and then, obviously, but lots of optionality. But you're going to have to also spend a lot of money to do that. So that project sounds quite interesting to me, Gold Road, which is why I asked initially about what's the plans for El Limon, because if that's producing cash, does that finance your work in Gold Road? And that's a nice way to make sure there's no dilution, or do you feel that you can structure a deal whereby there's very little dilution for existing shareholders going forward because you are producing, there's some cash, there's some leverage to be had?
So we've invested into Gold Road. The acquisition plus the work that's been done so far is about $22 or $23 million. Mm-hmm. We probably got another $3 or $4 million worth of development work to do before we actually start mining. But the way that we've designed the development plan and the mine plan, we'll be able to go to 500 tons per day right away. And I mentioned that we're stockpiling some material, but once we've completed the development into the 900 level, we'll open up a number of different stopes, which will get us the 500 tons per day. So by the end of the year, we'll be producing positive cash. And in 2020, I mean, we anticipate in our financial model, which uses $12.50 per ounce for gold, that will generate somewhere between $18 and $20 million worth of free cash flow. So that's net of sustaining CapEx. So that part of that money, not all of that money, but part of that money will go into an exploration program to increase the reserves at Gold Road, but also to drill into the true vein.
Got it. How much cash are you sitting on today, and will you need to do another raise?
So we've got about $2 million in cash today. As I mentioned, we need another $3 or $4 million to complete the work at Gold Road. So we're either going to go and do another small financing, or we'll do it ourselves. But I mean, we're sort of moving along at pace. So we're not particularly concerned.
Right. Okay. So if it was you, that's an equity raise. That you're not putting money into the company as a loan or anything.
Right.
No, there's a question. Is it which? How would you put the money in if you put?
I mean, probably in the form of equity, but it might also go in some debt. We haven't really determined that yet. Okay.
So it's quite interesting because the management own a lot of this company. You're committed, right? You're in. So your decision making is, you can genuinely say you're aligned with the market properly. So that's mostly retail, Canadian retail, I would presume, is it?
There's a bit of I wouldn't necessarily call it institutional, but more sort of family offices that have written sort of bigger checks, and there are obviously some retail investors as well. But we've got probably 12 or 15 kind of mostly European family offices who have put in $250,000 or so each in previous financings.
Why European? Where does that come from?
There's just been a better appetite for this kind of a deal in Europe than there has been in Canada. It's not for lack of trying. I've done a lot of work to try and raise money in Canada, but I've gotten a much better reception in London, Zurich, Munich, and strangely, Budapest.
Right. Budapest. Okay, that's a new one. Okay.
Yeah. No, okay. I know. So, right. And it's, I think that, the Europeans have a little bit more of an affinity to gold than Americans and Canadians, as I mentioned before, have become distracted by marijuana.
For aforementioned reasons. Well, let's just then focus on those people, because I'm looking at the share price. You've had your highs and your lows. Highs of 21, 22, lows of 12. May was a strange month for you. What happened?
Well, there was a seller that decided to move his position, and I didn't. It would have probably been better, just in generally speaking, if he had called me and said,
Yeah.
I want to move this position, but
Yeah.
it took us a while to figure out where all the pressure was coming from, and
Right.
an initial contact with him was negative. He said, "No, I'm not a seller," but
Not me.
anyway, it is what it is. This is the joys
Yeah.
of being in the public market, right?
There
Especially
you
thinly
go.
traded.
Especially the junior market, for sure. I know. I've learned this over the past few years. Yeah, you could have crossed. It would have been great. Okay, so the outlook for you. I'm just trying to take it all in. There's a news story for me, news story for all of our subscribers. And we need to kind of get to the bottom of these things to understand what's the rationale, the thinking, the strategy, and how you got there. And I think you've done a very good job of outlining that today. But if I look at where the future is, you talked about M&A, but you're not. I don't think you're not in a position anytime soon to look at M&A. You've got a lot of moving parts here as it is. Or would you disagree with me in terms of timing of that? Is the M&A just a story you got to tell the market, or are you got to focus on what you've got? How are you tackling this?
I think that we're very focused on getting these two assets up and running and generating positive cash, but we're also pretty opportunistic. And
Right.
so there are some, and just sort of be careful how I say this, but there are some assets which are really good fits for us that are available, and we're moving forward on doing a deal with those. But
Right.
it's because it creates quite a bit more value. It's strategic, but also financial, and so we continue to see a lot of opportunity. And our goal is to build out a sort of mid-tier gold producer within the next 3 to 5 years. We think that we've got a fairly straight line to kind of 200,000, 250,000 ounces per year. It's not going to be easy, but we think we can do that with the cash flow that we will generate from these existing operations.
Right. Okay, that would be great. That'd be great if you could do that. So you are looking at these small, undervalued producing or near-term producing assets, building up a portfolio, looking at different country risk. Or are we back in Colombia and the States? What are you focused on?
We're not. There are some places that we would probably not go, but we have an advisor to the company who is the former Minister of Mining in Ecuador, and Javier Cordova, and he is assisting us on looking at opportunities in Ecuador and Peru and Chile, where he has very strong relationships with the government, and that is helping us to be able to sort of shortlist opportunities. As I mentioned, we're really focused on getting the existing assets cash flow and stabilized, but that's fairly near term for us. I mean, by the end of this year, both of these operations will be in full production and producing gold, and all of our models have been based on $1,250 an ounce gold. So in this environment where gold is trading higher, our projections of cash flow are probably on the conservative side, which is fine. But I think that there is going to be ample opportunity for us to look at new acquisitions or expansions of existing assets.
Okay, yeah. I guess for investors, they're getting into production and making money are two different things, and creating value is yet again something different. So in terms of those components, you're saying that you can get into production quite soon. Positive cash flow, that's a little bit further out. And I guess with some of these acquisitions, you may see some value being not realized, but being created for shareholders. Is that the way you see the future?
Yeah, I think that like every public company CEO, I think our stock is undervalued,
Good man.
and market cap is essentially 1 times projected 2020 cash flow. And so, our shareholders, I wouldn't say have been long suffering, but you're absolutely right. Our share prices stayed in a fairly narrow band between 12 and 25 cents for the last 3 years.
Yep.
And so I think that we're in a kind of a show me stage. And so
you said it.
We need to produce. So I'm expecting that as we go into 2020 and we start showing quarter over quarter improvements and positive cash, and we believe profits, that the market will say, okay, this is a real deal, and that we'll see some appreciation in the stock price. I mean, I could be wrong there because I don't pretend to understand the public markets, but or the sentiment of the public markets, but I think that if we're generating positive cash, people will take notice.
I think they will, and as you say, do what you say you're going to do consistently.
And we haven't really done anything in terms of promotion. We've sort of felt that it'd be better to wait until we're closer to achieving our goals and then start telling the story, rather than be telling the story and having people have to wait. So this interview and some of the other things that we're starting to do are in anticipation of actually getting out there and telling the story.
Well, I've enjoyed listening to it today, Geoff. Nice first pass, and let's stay in touch. Let's maybe the next few months sort of see how you get on, and as you get close to some of these catalyst moments.
Great.
Appreciate your time.
Thank you very much for your time.
Thank you very much for watching our video. We do aim to give you informed and intelligent information with which to make your investment decisions. So if you liked what you just saw, please give us a thumbs up. And if you want to see more insightful, in-depth, honest, and unbiased interviews, then please click the subscribe button. So thanks again for watching, and we look forward to seeing you again soon.